$1 billion did not just enter Bitcoin. $1 billion that was supposed to protect users in an emergency just got converted into Bitcoin. That is what happened. Binance took the fund designed to act like a financial lifeboat in a crisis and moved it out of stablecoins into 15,000 BTC. Not a test, not a hedge, not a side allocation, a full conversion. And that changes the entire conversation around Bitcoin, because this was not spare cash sitting on the sidelines. This was the capital meant to be there when everything else goes wrong. So now the real question is not whether Binance bought Bitcoin. The real question is why the biggest crypto exchange on Earth would trust Bitcoin more than a so-called stable asset when the money is supposed to be used in the worst possible moment. That is why this move matters far more than another treasury headline. A company buying Bitcoin is one thing. An exchange taking its emergency reserve and putting it into Bitcoin is something else entirely. It tells you that inside the industry, at the highest level, Bitcoin is no longer being treated like a volatile trade. It is being treated like core collateral, like strategic reserve capital, like something that can sit at the center of the system rather than at the edge of it. And if that thinking spreads from one major platform to the rest of the market, the impact is not small. It is structural. The move itself was simple, but the message behind it was massive. Binance completed a full transition of its user protection reserve into Bitcoin, taking roughly $1 billion that had been parked in stable assets and moving it into pure BTC. Around 15,000 coins. Locked, visible on-chain, public, traceable. The kind of move that tells you this was not done for optics alone. They wanted the market to see it. They wanted users to know where the fund was sitting. They wanted institutions to notice that the largest exchange in crypto had just chosen Bitcoin as the final form of its safety net. Think about what that says without any marketing language around it. In a crisis, the reserve is supposed to be dependable, predictable, ready. Stablecoins fit that logic because they are designed to hold their value in dollar terms. If an exchange needs to cover a shortfall, reimburse damage, or respond to an emergency, the traditional view would be obvious. Keep the rescue fund in something that does not swing wildly. Keep it calm, keep it liquid, keep it boring. Binance just rejected that entire framework. They effectively said the better long-term reserve is Bitcoin, even for the fund that exists for emergencies. That is where this stops being just another bullish headline and turns into a major signal. Because when a company buys Bitcoin for upside, the market can dismiss it as speculation. When an exchange places its protection reserve into Bitcoin, that is belief at a deeper level. That is not saying Bitcoin might go higher. That is saying Bitcoin is worthy of trust. Trust as reserve capital. Trust as balance sheet strength. Trust is the thing you hold when you are planning for stress, not just for growth. And once you understand that, you start to see the real importance of this move. It is not only about the $1 billion, it is about the category change. Bitcoin is slowly moving from being viewed as a risky asset that institutions tolerate to being viewed as a reserve asset that institutions prefer. That transition is everything. Because when perception shifts at the institutional level, price usually reacts later. First, the narrative changes inside boardrooms. Then balance sheets change. Then supply disappears. Then the market wakes up. What makes this even more powerful is that Binance did not just announce the move and ask everyone to trust them. They showed the wallet. They exposed the transaction trail. They let the market verify the coins on-chain. After everything this industry has been through, after collapses, hidden liabilities, paper promises, and balance sheet illusions, that matters. A visible reserve is not the same as a claimed reserve, and by publishing the address, Binance turned the story into something harder to ignore. Anyone can watch the coins. Anyone can track the balance. Anyone can see that this is not just a press release. It is a real position. That transparency adds another layer to the signal. It tells users one thing and institutions another. To users, it says the fund is there. To institutions, it says Bitcoin is not only a reserve asset, it is a reserve asset that can be publicly proven in real time. Try doing that with most traditional systems. Try getting this level of live auditability from the old financial world. That is part of what makes Bitcoin unique. Not just the scarcity, not just the decentralization, the verifiability. The fact that the asset can be held, counted, and monitored without asking permission from a middleman. Now step back and look at the market effect. 15,000 Bitcoin may not sound world-ending in isolation, but that is not how supply shocks work. The market does not need every coin to disappear. It only needs enough coins to become unavailable while demand stays alive. That is where pressure builds. And Bitcoin is already a market where a huge portion of supply is effectively frozen. Lost coins, long-term holders, corporate treasuries, ETF custody, dormant wallets, coins sitting with people who do not care about selling the next green candle. Add exchange reserve funds to that list and you tighten the float even more. That is why this matters beyond the headline number. These are not trading coins. These are not coins meant to be flipped next week. This is reserve capital. Capital tends to stay put. And when Bitcoin gets moved into strategic buckets instead of speculative buckets, the available supply shrinks in a way the market often underestimates. The headline says 15,000 BTC bought. The deeper reality is 15,000 BTC reclassified out of circulating opportunity and into long-term strategic storage. Now ask the more explosive question. What happens if others follow? Because that is where this can get serious very fast. If one exchange does it, the market can still label it unique. If several do it, the market has a trend. And trends in reserve behavior matter. If other major platforms start deciding that Bitcoin is a better reserve asset than stablecoins for at least part of their protection funds or treasury structures, then this stops being an isolated event and becomes a new model. Suddenly, tens of thousands of additional coins are no longer floating in the market. Suddenly, Bitcoin is not just being bought by ETFs and public companies. It is being absorbed by the infrastructure of the crypto industry itself. That is the kind of shift that can accelerate a move far beyond what most people expect. Because Bitcoin does not need universal adoption to squeeze higher. It needs incremental institutional conviction. It needs one more category of buyer to decide, we need this on the balance sheet. Then another, then another. And every time that happens, fewer coins remain accessible. The market looks liquid until it is not. It looks deep until size comes in. It looks fine until demand collides with a supply base that is already spoken for. There is also a second layer here that people are missing. This move is not just a Bitcoin vote. It is also, indirectly, a stablecoin warning. Not a collapse warning, not an extinction warning, but a confidence warning. Because when a major platform chooses to move emergency capital away from a dollar-pegged instrument and into Bitcoin, it is telling you something about perceived trust. Stablecoins may be useful. They may be liquid. They may be essential plumbing in this market. But they are still tied to issuers, counterparties, banking rails, regulation, and the possibility of interference. Bitcoin is different. It does not need an issuing company to remain Bitcoin. It does not need bank hours. It does not need permission to exist. And for institutions thinking further out, that difference matters. That is why this move could end up having consequences much bigger than one balance sheet adjustment. If more major players start deciding that the ultimate reserve inside crypto should be the native asset of the system, not a synthetic dollar representation living inside it, then capital rotation into Bitcoin could intensify over time. Slowly at first, quietly, then all at once. Because once reserve logic changes, portfolio logic often follows. But let's deal with the uncomfortable side too, because this is where the story becomes more controversial. An emergency fund in stable assets is easier to model. An emergency fund in Bitcoin is harder, because Bitcoin does not stand still. If the asset rises, the fund gets stronger. If the asset drops hard at exactly the wrong time, the dollar value of that protection fund shrinks right when users might need certainty most. That is the core gamble in this entire move. Binance is effectively betting that Bitcoin's long-term strength compensates for short-term volatility, even in a reserve context. And that is not a small bet. That is the part nobody should ignore. Because if the market enters a violent drawdown, a fund measured in BTC can look powerful in coin terms while being weaker in dollar terms than it was before. So the brilliance of this move and the risk of this move come from the exact same source. Bitcoin's upside is the opportunity. Bitcoin's volatility is the danger. Binance has decided that over the long run, the first matters more than the second. But that assumption only looks genius if Bitcoin keeps proving them right. This is where smart investors need to separate the signal from the emotion. The signal is very bullish. The emotion can get reckless. Just because Binance shifted its reserve does not mean every person should suddenly go all in with no plan, no risk framework, and no time horizon. Institutions can survive volatility differently than individuals can. They have other assets, other revenue streams, other buffers. Their balance sheet is not your balance sheet. Their risk tolerance is not your risk tolerance. So the correct takeaway is not blind imitation. The correct takeaway is to understand what this move reveals about how powerful players are beginning to view Bitcoin. And that is where the portfolio implications become clearer. If major entities are increasingly treating Bitcoin as reserve-grade capital, then long-term accumulation makes more sense, not less. It strengthens the case for patience. It strengthens the case for thinking in years rather than days. It strengthens the case for refusing to be emotionally shaken out by every short-term move if the deeper adoption trend keeps expanding. Because what Binance just showed the market is that institutional conviction is moving closer to the core, not drifting away from it. At the same time, it reinforces the importance of discipline. A strong Bitcoin view does not eliminate the need for balance. It does not remove the value of liquidity. It does not erase the role of diversification. Bitcoin may be emerging as the flagship reserve asset of crypto, but that does not mean every other holding becomes irrelevant. What it does mean is that the hierarchy is becoming clearer. Bitcoin sits at the center. Everything else rotates around it. And when the largest exchange on Earth starts positioning its protection capital that way, that hierarchy becomes harder to deny. The biggest mistake people make in moments like this is focusing only on the immediate price target. Will this push Bitcoin to 100K? Could it help fuel 150K? Is 200K suddenly realistic? Those are exciting questions, but they are not the deepest ones. The deeper question is what kind of asset Bitcoin is becoming in the eyes of the people with the most capital, the best information, and the strongest incentives to think carefully. If the answer is a reserve asset, then the long-term implications are enormous, because reserve assets attract a different quality of demand. Slower demand, stickier demand, more strategic demand. Demand that does not vanish because of one ugly week on the chart. And that is why this move may end up being remembered as more than a purchase. It may be remembered as a declaration. A declaration that inside crypto, the asset designed to be decentralized, scarce, auditable, and sovereign, is increasingly the one major players trust most when the stakes are highest. Not just for upside, not just for optics, for security, for reserves, for credibility. So yes, $1 billion just moved into Bitcoin, but the real story is bigger than the number. The real story is that the money designed to protect users in an emergency was judged more valuable in Bitcoin than in a stablecoin. That is the shift. That is the message. And if the market fully understands what that means, this may not look like an isolated event for very long. It may look like the start of a new standard. Because once Bitcoin becomes the asset institutions want at the center of the system, not just at the edge of it, everything changes. The demand profile changes, the supply pressure changes, the narrative changes, and eventually the price changes too. So now the market has to answer a simple question. Was Binance early, or was Binance telling you where all of this is heading next? And that is the part you should be watching very closely. If this move caught your attention, watch what happens next, because the follow-through matters more than the headline. And if you think other exchanges could eventually make the same kind of move, drop your view in the comments. If you want more breakdowns like this, subscribe and stay close, because the next big signal usually looks obvious only after the market has already moved.